Stocks and shares ISAs and SIPPs are two types of investing accounts that offer us tax relief as UK investors. Both of these accounts have advantages and disadvantages depending on your own personal circumstances. So, which of these types of accounts is best for you? Remember, I'm no financial advisor, which is why I'll not be making any recommendations in this video. I'll just be presenting the facts. So, if you want independent advice tailored to your own circumstances, then seek that from a professional. A lot of the information in this video is based from a Vanguard article, so I'll make sure to put that link in the description below in case you want to check it out. Now, before we look at which of these accounts is best for you and do a fully simulated investing scenario, let's first take a look at both of the options that we have. First up, we have a stocks and shares ISA, which is the staple of ingredient of most UK investing portfolios. It is a type of investing account that allows you to invest up to £20,000 per year tax-free. This means that you won't have to pay any tax on capital gains when you sell investments from within your ISA, and you also won't have to pay dividends tax on any dividends that are paid out within your ISA. You can only have one stocks and shares ISA with just one provider each tax year, and you should definitely make use of it, instead of just investing in a general investing account. But as investors looking for tax-free benefits, we can also invest in a SIPP, which stands for Self-Invested Personal Pension. This is a type of pension account that allows you to make tax-deferred savings towards your retirement. You can deposit up to £40,000 per year. The money is only accessible after the age of 55, but this age is probably going to increase over time. If you try to withdraw the money before then you're going to incur huge tax penalties. It's worth mentioning that SIPPs are typically separate from your private pension that you'd have at work. Private pensions will often include employee contributions, which is essentially free money. Your employer will match your contributions up to a certain percentage as a bit of an incentive. Because of this, it can sometimes make sense to prioritise your private pension over your SIPP to make sure that you're making the most out of that free money. But let's assume that you're doing that already, and you want to know whether a stocks and shares ISA or a SIPP is better for your extra savings. Well, a key characteristic of a SIPP is that any money that you deposit into it will be boosted by the government, depending on your income tax rate at that time. This graph from a Vanguard article shows the growth of £100 invested per month by a basic rate taxpayer, with a 5% increase in contributions each year and with 5% returns per year. The SIPP includes a 20% bonus on every deposit because of the tax relief that the government provide, meaning that the growth is much more significant. If the investor was a higher or additional rate taxpayer, then the tax relief would be boosted to 40 or 45% respectively, which would have a big impact on your returns. So it's easy then. A SIPP wins every time, right? No. The downside to a SIPP is that when you eventually come to withdrawing money from it, normally during retirement, you have to pay income tax on the withdrawals. 25% of your withdrawals will be tax-free, but then the other 75% will be taxed depending on your income tax rate at that time. In comparison, when you sell out of a stocks and shares ISA, you won't have to pay any tax at all, so all of your investment is yours, not the taxman's. As I mentioned before, SIPPs are great for tax deferral, but they don't completely protect you from tax. So unfortunately, this question can be quite a complicated one. It depends on what you value more. Do you want to not pay any tax at all with a stocks and shares ISA, or do you want to invest in a SIPP, where you're going to get a boost at the beginning, but you're going to have to pay income tax at some point in the future? The best option for you could well depend on your tax bracket, both when you make the deposits and when you make the withdrawals, and it's also going to be affected by your withdrawal rates. To make it even more complicated, there is also something known as the lifetime allowance that can sting you when you invest in a SIPP, but more on that later. Despite this being quite an intimidating subject, let's break down what we know, so that you can make an informed decision on which type of account could be best for you. First up, we have the accessibility aspect of both types of accounts. A stocks and shares ISA is about as flexible and accessible as you would like. There is nothing stopping you from withdrawing money from a stocks and shares ISA at any time. Just bear in mind that if you have a stocks and shares ISA that you already deposited 20k into, you can't then withdraw some money and then deposit some more. Once you've deposited the 20k, that part of the ISA allowance is used up. But there is nothing from stopping you from, say, investing 20k per year for 15 years and then finally deciding you want to cash out and sell everything. This makes it easier to invest towards shorter term goals, instead of just investing long term for retirement. A SIPP, on the other hand, does not share the same flexibility. If you want to access that money before the age of 55, then you can't really do it without incurring a huge tax penalty. HMRC will tax the money at 55%. But it is also very difficult to do, and providers will charge a fee to do so, meaning you could end up losing most of your pension by doing this. Whilst you could see this negatively, it might not necessarily be such a bad thing, as it would improve investor discipline. Because it's going to be so hard to withdraw the money, you're probably not going to withdraw the money, so you're going to stay invested for longer and your investments should perform better. With it being so easy to dip out of a stocks and shares ISA, it makes it that much easier to bail out on long-term investing goals. The next thing to consider is the limits that both types of accounts have. A stocks and shares ISA allows you to invest up to 20k 30k per year, whilst a SIPP allows you to invest up to 40k per year. It's worth noting that it can be possible to carry forward the 40k per year SIPP allowance from the previous 3 tax years, if you haven't used any of it up. So if you haven't invested any money in a SIPP over the past 3 years, it could be possible to invest up to 160k during the current tax year. Because of these limits, you might be forced to invest in either type of account, when your allowance from the other account fills up. The comparisons that we've been making so far have all been pretty trivial, but it's time to bite the bullet and jump into the taxes. It's not going to be so bad, I promise. First up, we'll cover the lifetime allowance, which we discussed earlier. This is essentially a limit on how much you can withdraw from your pension before you start to incur further taxes. Currently, the lifetime allowance triggers after you have claimed or crystallised £1,073,100. This amount could fall over time if the government look at other areas to tax, but at the moment it is locked in at that value till 2026. If you do end up exceeding the lifetime allowance, then you have to pay a further 25% tax on pension income and 55% tax on lump sums. Of course, it's going to be quite hard to know exactly how much you're going to withdraw from your pension over your retirement, because it's going to depend on how long you live for and how well your portfolio performs. But as an example, let's say you took a lump sum of 50k when you retired, and then an income of 25k per year for 20 years. In total, you'd end up withdrawing 550k, so you wouldn't trigger the allowance. However, if you were to take a 50k lump sum, but withdrew 50k per year for 25 years, you'd withdraw a total of £1.3 million. So any withdrawals which are made after the lifetime allowance was exceeded would be taxed further. This is just a consideration that you may need to make if you expect to have a high income during retirement. Just remember that any withdrawals from a stocks and shares ISA aren't going to count towards your lifetime allowance. Next up, we have income tax to consider. Remember, any withdrawals that you made from a stocks and shares ISA aren't going to be triggering any income tax, but withdrawals from a SIPP will. When we're older, we're going to have various forms of income, from the state pension, private pensions, any employment or self-employment, taxable benefits, or income from investments that aren't in a tax-free wrapper. So, depending on how much income you have, you're going to fall into different income tax rates, just like you do now. It's worth noting that we all have a personal tax-free allowance of £12,570, which we're allowed to earn without paying any tax on. After this, the different tax rates are shown on screen now, with the basic tax rate at 20%, higher rate at 40%, and the additional rate at 45%. You do have to remember that when you initially deposit into a SIPP, you are going to get a boost depending on what your income tax rate is at the time of the deposit. So in a way, it's a sort of balancing act. You get a little boost at the beginning when you first make the deposit, but then at the end, you're also going to get stung with tax when you withdraw from the account. You can use this to your advantage though. Let's say you made the deposits as a higher rate taxpayer, so you get a 40% boost at the beginning. But then you make the withdrawals as a basic rate taxpayer, so you're only going to get taxed 20% at the end. This means you've kind of made a profit. Of course, it's going to be difficult to know exactly how much income we're going to have when we're older. And realistically, if you're an investor with a full state pension and other types of pension, then you're probably not going to be a basic rate taxpayer. But it's still worth considering. To help us get our heads around the tax side of things for both types of account, we'll run through an example that we made up, where we're going to deposit and then withdraw money from different types of accounts for different tax situations. Let's imagine that we'll be investing for 30 years, whilst depositing £250 per month and earning 6% per year on our investments. This graph shows the total growth of the different types of accounts. The key is at the top. The stocks and shares ISA grows to the smallest total amount, because there is no boost added for each deposit. There are then 3 different SIPP growths, depending on the tax rate of the investor when they made the deposits. If you make deposits as an additional rate taxpayer, you're going to get the biggest boost of 45%, whilst a high rate gets a 40% boost and a basic rate taxpayer gets a 20% boost. Of course, an additional rate taxpayer will be getting taxed 45% every payslip that they get from work. So in a way, it's kind of harder for them to make the £250 deposit per month, because the boost that they get is really just a tax refund. The end amounts for each account are £250,000, £300,000, £350,000 and £365,000. So now let's move on to retirement, and we're going to assume that the investor wants to make withdrawals such that they can have an income of £20,000 per year. The investments are still going to grow at 6% per year. This first graph shows the drawdown from the ISA, which turns negative after around 21 years. The graph gets steeper as time goes on, because the total amount is decreasing, so the 6% growth gets smaller and smaller each year, whilst the withdrawals stay at £20,000. To say that the stocks and shares ISA had the least growth to start with, 21 years is pretty good going. We'll move on to the SIPPs next, but it does get a little bit complicated because of the different tax situations that can be going on. As we mentioned earlier, we could withdraw from the pension as a basic, higher or additional rate taxpayer, but we still want £20,000 per year income. £5,000 of that, or 25%, is going to be tax free, but the other 75% will be taxed. This means that a basic rate taxpayer will have to withdraw £23,750 per year, a higher rate will have to withdraw £30,000, and an additional rate would have to withdraw £32,000 per year. And as we saw before, the initial portfolio value is going to depend on the tax bracket that you were in when you made the deposits. So we've got 9 different combinations that we're going to split into 3 different graphs. Hopefully it'll be clear. This first graph shows the different SIPP drawdowns as a basic rate taxpayer at 20%. Each withdrawal is £23,750 and the starting amounts all vary depending on the growth values we saw earlier. If you were initially an additional rate taxpayer but then withdraw as a basic rate taxpayer, your portfolio will last 34 years, compared to 31 years and 21 years for the other 2 options. The next graph shows the different options when withdrawing as a higher rate taxpayer, and the longevity of the portfolio decreases massively. These different drawdowns only last between 14 and 20 years, as each withdrawal is actually £30,000. The next graph shows the withdrawals as an additional rate taxpayer, which is even worse. The portfolio lasts between 12 and 17 years, as each withdrawal is actually £32,273. The final graph has all of the drawdown options together. It's a lot of data, I know, but bear with me. The blue line shows the stocks and shares ISA drawdown. The green lines show the SIPP drawdowns as a basic rate taxpayer, the orange lines show the SIPP drawdowns as a higher rate taxpayer, and the red lines show the SIPP drawdowns as an additional rate taxpayer. The stocks and shares ISA and the basic rate SIPP withdrawals beat the other options comfortably. As you start to pay more tax during retirement, the longevity of your SIPP decreases massively. If you can be certain that you will be dropping a tax bracket in the future, then you could benefit from a SIPP. But then also, a stocks and shares ISA is flexible and it performs well. You do have to take these graphs with a pinch of salt though, because this is just one example with some approximated data, and you can never really be sure what future income tax rates are going to be. I've also not considered the lifetime allowance here, but none of the examples that I've just shown would have been enough to trigger that. The main takeaway from all of this is that depending on your personal circumstances, there is a lot to consider. There is flexibility, accessibility, account limits and tax. And all of these factors are pulling in different directions. Unfortunately, I can't tell you which type of account is best for you, because I'm not qualified to do that, and I don't know your personal financial situation. Ultimately, this is an area where financial advice is very relevant, and I would really recommend it. In fact, 2 of my mates are actually financial advisors, and they've also got YouTube channels, so I'll make sure to put links to those in the description so you can check them out. The content's awesome. All I'm here to do is present you with the facts, so that you can know a little bit more when deciding between the 2 different types of accounts. Hopefully, you found it useful. If you did, then let me know in the comments. And if you didn't, then just pretend that you did. And with that, I'll see you in the next one.